All right, let's do a few more questions. The rest of our questions for this podcast come from a dentist. A dentist is actually doing pretty well. He says he's got his student loans, mortgage loans, and practice loans all paid off, despite only being 35 years old. His wife works part-time, but's planning on quitting to spend more time with the baby. And they're looking at starting investing now. Well, it looks like they really focused down on the loans those first few years, if they're just now starting investing and they're already debt-free. He says he looked into offering a 401k for his 5 employees and himself, but based on the employees, it would be extremely expensive to make it worthwhile. That's not unusual. The alternative would be to offer a simple IRA, but then I wouldn't be able to do the backdoor Roth IRA anymore. Plus, it'd only allow me to put in $12,500 for me and $12,500 for my wife. And my employees are okay with their current benefits, so I'm thinking about just sticking to after-tax investments. What do you think? Well, I think that's a fine plan. The truth is, once you have employees for your practice, whether you're a dentist or a dental specialist or whether you are a physician, once you have employees in there, a retirement plan is no longer a do-it-yourself project. If it's just you as an independent contractor, go get yourself an individual 401k. But if you have employees, you can't do that. So you really need to get an expert in there to look at your practice, look at the ages of your employees and how much they're likely to save and how much you want to save, and kind of do a study of it and decide what's right for you. And sometimes that might be a simple IRA. Sometimes it might be a SEP IRA. If the option is one of those choices, you're not going to be able to do a backdoor Roth IRA. Maybe it makes sense to have a 401k of some type. And then sometimes it might not make sense to offer anything to your employees. And so you've really got to dive into the weeds here and have this discussion with professional and your employees and decide where to go. But certainly you can save for retirement in a taxable account. Between your taxable account and your backdoor Roth IRAs, maybe that's all you do. And that's okay. You can certainly save enough in those. He also asks, on your last podcast you spoke about municipal bonds and their tax advantages for after-tax investing. Where can I learn more about best strategies for after-tax investing? And I've got several posts on the White Coat Investor blog about taxable account investing. So if you just search taxable account there, I'll walk you through some considerations you ought to have when you're choosing investments for your taxable account. But the bottom line is you want to have relatively tax-efficient investments there. And so what typically goes in are total market index funds, like a total stock market fund and a total international stock market fund, municipal bonds, usually in the format of a bond fund, or real estate, in that a lot of real estate income can be sheltered by depreciation. So the idea is to use tax-efficient investments there, use them tax efficiently, do tax loss harvesting. If you donate to charity, use appreciated shares for your donations, and that's basically how you do a taxable account. He has 2 other questions. The first one is kind of a classic. Why bonds? Lots of people wonder, why should I use any bonds? And he says specifically for 30-something doc like me, a year out of training, why should I put any of my 401k or other investment money in bonds as opposed to investing in equities and a smaller amount in real estate? I understand the bonds have much lower risk, and every book I've read recommends a minimum of 10% bonds for anyone. But since I don't plan on touching any of these funds until retirement, it could be reasonable to invest no money in bonds for now, and then add that to my portfolio maybe 10 years in the future. Well, this would be a relatively aggressive investment strategy, I agree. It seems that I could tolerate any changes in the stock market over the next 10 years before I made my portfolio more conservative by adding bonds. I find that an interesting phrase. It seems that I could tolerate. Well, maybe you can tolerate it. Maybe you can't. I have no idea. And I would propose that until you go through a big bear market, you don't have any idea either. It's also entirely possible, even though it may not be that likely, that bonds outperform stocks over your investment horizon. Bonds have outperformed stocks over relatively long periods before, 10, 15, might even be a 20-year investment period out there where bonds have outperformed stocks. And so those are the 2 main reasons to have bonds in your 30s, even with a small portfolio. Benjamin Graham recommended that you never have more than 75% stocks or less than 25% stocks. And I think that's a pretty good general rule. But obviously there's lots of reasonable people out there that can disagree. However, when setting your risk tolerance, it's like The Price is Right. You want to get as close as you can to your risk tolerance without going over. His last question was about target date retirement funds. He says, I have Roth IRA funds in a Vanguard target date fund with an expense ratio of 0.15%. I can instead put that money directly into the component individual index funds with an expense ratio of about 0.04% if I use the ETFs. I don't actually have enough funds to purchase Admiral shares in all categories. So is this difference in fees 0.1% large enough to justify the time needed to rebalance the account and adjust asset allocation through retirement? I understand that I could choose a different asset allocation and different glide path, but I don't have any evidence-based reason to think that my choices would be better than Vanguard's settings for its target date funds. And I agree with that. You don't have a reason to think your choices are going to be better than Vanguard's, and they could very well be worse. But here's the deal. The main problem with target retirement funds for most stocks is they're just not available in all of your accounts. So it doesn't make sense to use them in one account and not use them in another account. Is it worth saving 10 basis points to roll your own? Probably not if you can't get enough that you can get the minimum to get Admiral shares, which is $10,000 per fund. If your retirement portfolio is, a 4-figure amount or a low 5-figure amount, it probably doesn't make sense to try to save 5 basis points. If you got $1 million account, maybe it's worth the extra hassle to roll your own target retirement fund there. Finally, he gives me a little follow-up email and says, I've always been a little surprised by the idea that residents and fellows should learn financial literacy from the ACGME or through some aspect of their training programs. After all, I didn't expect the attendees of my residency to teach me how to prepare healthy meals or to lead exercise classes at the end of the day, which is arguably more important than financial wellness. Clearly, the WCI Universe content is so much better than anything the ACGME provides on financial literacy that the ACGME and residency should simply distribute your book or at least a link to your website rather than trying to teach residents about everything under the sun. Boy, that'd be awesome if they'd do that. That said, props to the scattered academic docs out there talking to the residents and giving them the basics of financial literacy. Well, here's the deal. You spend so much time in training between medical school and residency and fellowship. What's a couple of hours here and there of financial literacy? I don't think we're asking too much here to have a little bit of that in medical school and a little bit of that in residency. Obviously, this is never going to take the place of, your primary specialty training. But it wouldn't be that hard for once a year give a few hours of financial kind of stuff. I think there's plenty of room in the curriculum for that, and certainly the focus on wellness that we've had the last few years is probably worthwhile doing. All right. If you spend any time on Reddit at all, be sure to check out the White Coat Investor subreddit. It's not as active as I'd like to be, and it sure would be nice if we could get a core group of people there dropping in there each week like we have on the forum and the Facebook group. There are a lot of people on Reddit, and I think the WCI message isn't getting to them as well as I'd like to see. So if you like Reddit, please stop by the White Coat Investor subreddit once a week or so, answer some questions from people, and let's see if we can build a community there as well. This episode was sponsored by Alexis Galati of Galati Professional Services. Alexis is not your typical tax advisor. With over 15 years of experience, she's been helping physicians all over the country save money on their taxes. As the spouse of a busy physician, she understands the burden of high tax payments physicians incur during their lifetime. Not only will she create a high-level strategic tax plan for you, guaranteeing money in your pocket, but Alexis will proactively work with you throughout the year to maintain your tax plan, prepare your annual tax returns, and represent you in case of an audit. The investment in her tax planning services is a fixed price agreement, and her tax maintenance packages are a flat monthly fee. If you're tired of complex tax jargon and giving away most of your paycheck to the IRS, visit Alexis's website at www.galatitax.com. That's GALLATI tax.com today to schedule your free initial consultation. Head up, shoulders back. You've got this. We can help. The whole White Coat Investor community is here to support you in reaching your financial goals. We'll see you next time on the White Coat Investor Podcast.